When I started writing about finance, the world, according to Wall Street, was promoting something called the efficient markets theory. In a nutshell, this theory contends that the day-to-day price movements of stocks and bonds are ultimately rational, based on investors making informed and savvy choices about what to do with their cash at any given moment of the day. The idea was that we all went into the investment markets with a fistful of cash and all the accurate information we'd need. Then our conversations would go something like this. That stock is a bargain at this price. Buy. Those bonds aren't yielding enough. Sell and redeploy our capital. As the market moved to reflect the increasing demand on the savviest investments and the dearth of buyers for the less attractive investments, the prices would shift accordingly, and investors would make new choices. Supply and demand are always in sync, and investors are always rational. The bulk of the world has now recognized this controversial theory to be largely irrelevant to individual investors. It's not that people never make rational decisions about their money. They do, just not all the time, and not even when taken as a group. Wall Street's favorite theory is now behavioral finance. This theory explains why smart people often make dumb decisions about their money. The great thing about this shift is that behavioral finance is something we all can relate to. We know instinctively, or from personal experience, that ignorance, fear, or greed can get in the way of making smart choices. Instead of decisions, we make excuses. Instead of making money, we make, a mess. This book is going to tell you how to invest wisely. Investing 101 is simple. It's straightforward. You'll get step-by-step instructions throughout. Anyone who reads and follows the directions will find investing easy to do. But if you let bad money habits overshadow your money smarts, your road to wealth will be long and bumpy. How do you avoid that? Like anything else, you identify the problem and find a solution. Here are some of the most common problems that face investors, and simple ways to fix them. Many of these problems won't relate to you, so skip them, unless you simply want to gloat. Certain investment roadblocks are universal and can be relevant for any investor. Other problems are more likely to strike women than men, or men than women. The following sections look at all three types. Universal problems. Problem: saving too little or not at all. I would invest, but I just don't have the money, says the well-dressed 25-year-old driving a BMW. I'm going to start as soon as I get a raise. Okay, that was a slight exaggeration, and it would be easier to save if you earned more money, but sometimes life is just not fair. Now, be fair with yourself and answer honestly. When was the last time you bought lunch or dinner at a restaurant instead of going for the cheaper alternative of packing a sack lunch or making your own dinner? When was the last time you bought a suit, a high-tech gadget, or a pair of shoes that you knew you didn't need? If you have a job that pays a decent wage, meaning anything that keeps you above subsistence level, you can afford to invest. Spend $2 less per day, the cost of one Starbucks coffee, or one snack from the vending machines, and you've got $60 a month. That's enough to plop into an automatic investment plan with a mutual fund. Still think it's a matter of poverty, not spending habits? Did you know? Saving habits and salary bumps. A number of studies have been done about whether individuals can afford to save based on their income. They have found that aside from people at the polar ends of the income scale, the very rich and the very poor, the bulk of people in between think they could save, at least small amounts. Often it's a matter of whether they do, rather than whether they can. Increases in salary often lead to incremental increases in spending, rather than increases in savings. This suggests that saving is a matter of habit, not income. If you aren't saving now, you won't start when you get a raise.